Welcome back to Investing Talk Podcast.
Today we're looking at Destiny Tech 100.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And the first thing we really need to understand is that we're not talking about a normal tech business here.
Right. This isn't a company that sells, a product or a service.
Exactly. We're looking at a different kind of vehicle altogether. It's a registered closed-end fund.
Okay, so let's break that down. For someone who's used to looking at, say, Apple's iPhone sales or Amazon's revenue, how do you even measure success here? PE ratios are out the window.
They are. You have to shift your entire mindset to investment metrics. It really boils down to two things: net asset value, or NAV, and the total fair value of the portfolio.
So the value of all the stuff they own, basically.
Pretty much. DXYZ owns a slice of about 100 private tech companies, and its own value is just a reflection of what those private holdings are worth.
And what's the latest data from Q3 2025 telling us? Is the value of those holdings going up?
It is. We're seeing some really strong positive momentum. The NAV jumped pretty significantly, up to $11.37 per share.
Wow, okay. That's a critical signal then, right? It means the people valuing these private assets are marking them up, and by a lot.
A whole lot. It's a clear sign that the fund's holdings are becoming more valuable on paper.
And what does that look like on a larger scale? What's the total portfolio value we're talking about?
The total fair value of the portfolio is now sitting at around $153.3 million.
I see.
And that shows they're not only scaling up their exposure to these late-stage tech companies, but they're building what you might call embedded optionality.
Embedded optionality. So every dollar it's marked up now has the potential to be worth even more later on.
That's the key, especially when one of these companies has a big exit, like an IPO.
That structure feels like it has a big advantage over a typical startup that's just burning through cash.
Oh, absolutely. Because it's a fund, its balance sheet is incredibly clean. It's all investment assets backed by cash. There are no heavy operating costs or, big capital expenditures.
So the rising asset value directly benefits you, the shareholder, without that operational drag.
Yes. It offers a kind of built-in downside protection. Plus, their strategy is all about capital appreciation. They reinvest everything, which is perfect for this kind of high-growth world.
Okay, so the engine is solid. Let's talk about the fuel, the portfolio itself. This gets to its real competitive advantage, its moat. What makes this fund so special?
It all comes down to one word: access. Think about it. 99% of investors out there simply cannot buy shares in a pre-IPO company like SpaceX or Stripe.
Right. That's a world reserve for huge institutions and, the ultra-wealthy.
Exactly. And Destiny Tech 100 basically opens a door for the public to get into a curated basket of these top-tier pre-IPO unicorns.
But how do they do that? I mean, how does a publicly traded fund get around all those regulations? It seems like a contradiction.
It's a really clever mechanism. The closed-end fund structure is basically the key. It acts as a legitimate funnel to bypass the traditional limits on who can buy private shares.
So it's about the structure.
It's the structure, and it's also about who's running it. The founders have this, what people call a forged global pedigree. They have deep connections in that world.
And why is that pedigree so important? What does that actually mean for an investor?
I mean, it's everything. Getting your hands on pre-IPO shares isn't just about having the cash. It's about having the network, the trust, the ability to source those shares from early employees or VCs.
So they're on the inside track.
They're on the VIP list, yeah. This is one of the only ways for a regular retail investor to get this kind of diversified exposure to these unicorns before they go public. It's a very powerful niche.
That access brings us right to the elephant in the room. Or maybe I should say the rocket in the hangar. The single biggest driver of this fund.
We have to talk about SpaceX. There's no way around it. It's their top holding, and it completely dominates the narrative here. It's the source of the volatility, the hype, and, well, the incredible upside potential.
And the news coming out about SpaceX's plans is just staggering. What are the latest reports saying about a potential IPO?
The reports have been pretty consistent. SpaceX is apparently targeting an IPO for as soon as 2026. And the valuation they're aiming for is, what's $1.5 trillion.
$1.5 trillion. That's almost hard to comprehend. That's bigger than almost any company on the planet.
It would be a landmark event in financial history, and they're looking to raise something like $30 billion. It's just a phenomenal number.
So what does that catalyst, a $1.5 trillion story, do to this fund's NAV when that starts to become real?
It's a direct structural tailwind. There's no other way to put it. If SpaceX gets anywhere near that valuation, it's going to trigger a massive, massive step function increase in the fund's biggest holding.
A huge jump in value.
A huge jump and a clear path to liquidity for that position. And since the fund is all about reinvesting for capital appreciation, they're perfectly set up to ride that wave.
Now, they're holding a ticket for a launch that's scheduled for 2026.
That's a great way to put it. The whole strategy aligns with that appreciation curve.
Okay, now let's bring this back down to earth for a minute, because
Yeah.
despite this incredible catalyst, the stock itself is known for extreme volatility. It swings wildly. How do you square that with an NAV that's steadily rising?
That is the central puzzle with this fund right now. You're right. You can't ignore the price swings. The stock is just incredibly sensitive to everything. SpaceX news, political news, even, frankly, those meme stock cycles.
So what does that volatility actually mean when the price is so disconnected from the NAV?
Well, that's the NAV disconnect. The market is either pricing in way too much hype and trading at a premium, or way too much fear and trading at a discount.
Hmm.
But what's interesting is the upside sensitivity. We've seen the stock gap up 10% or more in pre-market, just on a rumor about a SpaceX IPO milestone.
So it has a tendency to pop on good news, a strong upside skew.
Exactly. Even a small piece of positive news can cause an outsized move because traders rush in to front-run the next official NAV repricing. They know that anchor value is moving up.
So even if the stock looks weak in the short term, if it's just trading sideways,
That consolidation can be the opportunity. You've got weak sentiment, but rising fundamentals from the NAV updates, and this huge, clear catalyst on the horizon with the SpaceX IPO. It's a classic buy the consolidation setup.
interesting. So the technical weakness can disappear very quickly when a catalyst hits.
Very quickly, new capital gets drawn in, and that overhang just fades.
That's a compelling bull case. But we have to look at the other side. What are the big structural risks an investor needs to be aware of here?
There are three big ones, and they're all kind of linked. The first, as we've said, is that high volatility and NAV disconnect. The price can be purely speculative. If you buy when it's trading at a huge premium to its NAV, you're paying way more than its assets are actually worth on that day.
That sounds like a good way to get burned.
Yeah.
How do you protect against that?
Discipline. The rising NAV is your anchor. The strategy is to try to get in near, or even better, below that published NAV when the market gets overly pessimistic. It takes patience.
Wait, what's risk number two?
Concentration risk, or, Musk risk.
Oh,
The fund is so heavily tied to SpaceX that anything that negatively impacts SpaceX, or frankly Elon Musk's reputation, can hit the fund's price hard. We've seen it happen.
so a single point of failure, in a way. How do you mitigate that?
Well, part of it is just the price of admission for this kind of opportunity, but the key mitigation is the rest of the portfolio. Remember, it holds about 100 different companies.
The embedded diversification.
That's the buffer. There could be the next big AI or fintech unicorn hiding in there that helps offset a shock to a single name.
And the third risk,
Yeah.
the final headwind.
It's the cost. This is not a cheap fund to own. It has a 5% expense ratio.
5%. Wow, that is steep. Compared to an index fund that's, what, less than 0.5%?
It's a massive difference. It's a hurdle you have to clear every single year before you even start to make a profit.
So why would anyone pay that?
You have to weigh it against the moat we talked about. Access. You're paying for access to assets you just can't get anywhere else. If SpaceX appreciates anywhere close to what's expected, the gross returns should, hopefully blow past that 5% fee.
So it's a bet that the unique access is worth the high price.
It's a bet that the potential for generational returns outweighs the structural cost.
Let's talk timing then. What's the catalyst calendar look like? What should people be watching for in the near term?
The most immediate things are the fund's own quarterly NAV and portfolio updates. That's the hard data. You want to see that NAV continuing to climb.
But the real fireworks, the things that cause those big price jumps, are external, right? They're tied to SpaceX.
Oh, absolutely. Any formal milestone in the SpaceX IPO process is a huge potential catalyst. We're talking about them hiring banks, filing regulatory papers, and the big one, S1 filing rumors.
Can you just explain for our audience what's an S1 filing and why is that such a big deal?
Sure. The S1 is the official registration form a company files with the SEC when it plans to go public. It's the moment the whole process becomes officially real and the details start coming out.
Got it. So even a rumor of that filing is a major sentiment booster.
A huge one. because it shrinks the uncertainty around that 2026 timeline. Those are the events that can trigger those really sharp, quick pops in the price.
So if you pull all of this together, the access, the SpaceX story, the volatility, the costs, what's the investment horizon we're really looking at?
The analysis points to a 12 to 36-month horizon. This isn't a trade. You're positioning yourself for the journey through those pre-IPO milestones and toward that 2026 IPO window.
That feels like a complete picture. This fund is really a rare opportunity for public investors to get into elite private tech, all anchored by this multi-trillion-dollar potential story with SpaceX. The whole reason it exists is to provide that asymmetric opportunity, gaining access to things that are normally off limits.
I agree. And a final thought for you to chew on. Think beyond just the SpaceX IPO itself. What happens if we see major macro tailwinds? Imagine a big rotation back into growth in tech stocks, or if the AI and new space economy narratives get even hotter. That could lift the valuations of the other 100 companies in the portfolio too, adding another whole layer of appreciation on top of the main catalyst.
Remember to subscribe to our show for more analysis like this every week.